Welcome to the data dawning, where the data speaks, we listen. It's time to unlock the numbers and decode the story. And welcome back to the deep dive.
Today, wow, we are tackling this incredibly fascinating stack of sources you shared with us. We're going from the really granular details of market mechanics all the way out to these big sweeping macro trends and, specific industry insights too.
It's quite a mix, isn't it?
It really is. So think of this as your custom deep dive, specifically designed to cut through the noise in this information you've gathered. Our mission, basically, is to pull out the most important nuggets, those surprising facts, the key insights that connect the dots.
Right.
Helping you get a clearer picture of this, well, let's face it, complex market landscape. We've got a lot to unpack.
We certainly do.
We're going to start with something that gives a really visual take on potential market moves, Bitcoin liquidations.
Yeah, it's a genuinely rich collection of material you've provided. Lots of data points.
Huh?
And sometimes they seem to pull in, well, different directions.
So our goal, like you said, is to try and make sense of these cross-currents, extract the signal from all that noise. And starting with Bitcoin liquidations, it's a unique window into the market structure, the part driven by leverage.
Absolutely. So maybe for someone less familiar, what exactly is a Bitcoin liquidation? And how does this heat map tool, help us understand them?
Okay, so at its core, a Bitcoin liquidation is basically the forced closure of a trader's leveraged position.
Leverage meaning they borrowed money.
Right. When traders borrow funds to make their bet bigger, whether they're betting the price goes up, long or down short, they're using leverage. Now, if the market price moves sharply against them past a certain point, the exchange automatically closes their position. It's to stop the trader losing more money than they actually have in their account. So it's a protection mechanism, really.
But for the trader, it's a loss.
Oh, definitely a loss for the trader.
Yeah.
And the heat map, it visualizes where these potential forced closures might be clustered.
Oh.
It aggregates data from different exchanges, different leverage levels. It shows us the price points that could trigger a lot of these positions being closed out all at once.
So those horizontal bands on the map we're looking at, those are price levels. And the colors tell us something about the intensity.
That's exactly right. Each band is a specific Bitcoin price. And the color, well, it indicates the relative density of predicted liquidations right there. Usually it goes from cooler colors like purple, meaning fewer potential liquidations, up to warmer colors like yellow, or even brighter sometimes. Those hotspots show the most concentrated areas where a whole lot of leverage is stacked up.
Got it. So you're looking for those bright yellow zones. What's the real value in seeing this, especially for someone trying to understand market dynamics?
Well, there are a couple of critical insights this tool gives you, things that go beyond just standard technical analysis. First, these areas with high liquidation density, they can act like price magnets.
Magnets, how so?
If the market price starts moving towards one of these zones, right, it triggers some initial liquidations. That can create a cascade.
Ah, a domino effect.
Exactly. As positions get closed, it creates these sudden bursts of market orders, selling if longs are getting liquidated, buying if shorts are. This concentrated activity can actually pull the price deeper into that zone, speeding up the move. It's kind of a self-reinforcing thing.
So the price gets drawn towards where all that potential energy is stored up.
Precisely. And second, these high-density areas represent points of significant liquidity.
Okay.
This is where the big players, the whales, can execute really large trades relatively quickly. Because there are so many liquidation orders potentially waiting there. A large player can get in or out of a big position without causing the price to gap wildly, at least initially. But their actions, combined with the triggered liquidations, can sometimes lead to price reversals, so they can act like powerful, maybe temporary floors or ceilings. It's where a lot of volume can suddenly get absorbed.
It's like seeing where the hidden traps are. Or opportunities, maybe, based on how people are positioned with leverage.
That's a really good way to put it. It's not about predicting direction with, 100% certainty.
Yeah.
It's more about understanding where volatility could spike and where these big market forces are likely to clash. But, and this is important, the heat map shows where liquidations might start, not necessarily where a price move will end or how far a cascade will go. And the densities are always relative to the snapshot you're looking at.
Okay, that makes sense. So looking at the specific heat map you've included in your sources here, this one shows a 24-hour view. What jumps out at you immediately?
Okay, yeah, let's look at the snapshot. We can see the current price is sitting just under $10,600. What's immediately striking is the density. both above and below this price.
Mm.
There's a really noticeable concentration of predicted liquidations clustered pretty significantly around the $10,400 mark. See that distinct yellow band there?
Yeah, I see it.
That indicates a high amount of leverage would likely get wiped out if the price drops to that level.
So if we saw a dip, $10,400 could be a target zone.
It definitely looks like a potential magnet area based on this data, yes. But then look higher. There's an even denser concentration. It really pops visually between $10,600 and $10,700. That band is a brighter yellow.
Wow, yeah.
That indicates a very high accumulation of leveraged positions just above the current price that are, well, vulnerable.
And that's right where the price is hovering now, or just below it?
Precisely. You look at the price action overlaid on the heat map for the last 24 hours. It shows exactly that. The price started below $10,400, traded up through it, and then spent time pushing right up against the lower edge of that $10,600, $10,700 zone before pulling back just a bit.
Okay.
And further below that $10,400 level, you also see other pockets of density, notably between, say, $10,200 and $10,300. They're not quite as intense as the zones we just talked about, but they still represent pretty substantial liquidation potential relative to other levels on this short-term view.
So for someone looking at this, maybe trying to make sense of it for their own trading or understanding, what's the key takeaway from these specific levels and these concentrations?
I think the key takeaway from this heat map for you is really recognizing that $10,400, and particularly that $10,600 to $1,700 range, are critical levels right now. And they're critical because they're heavily influenced by leveraged positioning.
Right, not just random technical levels.
Exactly. These aren't just arbitrary lines somebody drew on a chart. They represent areas where concentrated market activity driven by those forced closures and these big liquidity pools is most likely to happen. Understanding this adds a whole other dimension to predicting potential price targets or, areas where volatility might suddenly pick up, things that pure chart patterns might miss. You're seeing the market structure through the lens of leverage risk.
That really is a deep dive into the plumbing of the market, isn't it? It's not just charts. It's understanding the mechanics driving the price.
Exactly. It's looking at the actual positions of the participants.
Drop a like and share if you find this valuable. Okay, let's zoom out significantly now. From the specific price points of Bitcoin, let's look at the broader economic currents, the ones captured in your sources, specifically turning to insights from Darius Bale at 42 Macro for our Macro Minute. He's presented a perspective that, well, seems to challenge some conventional wisdom.
He really has. He's been very consistent for, almost 3 years now on this central theme, the remarkable resilience of the U.S. economy. He keeps noting that despite all these forecasts for recession or big slowdowns,
Right, we hear them all the time.
the actual economic data has stayed surprisingly robust.
And he attributes this resilience to several specific factors he's highlighted in your sources. What are those?
Yeah. Based on his analysis, the pillars holding this up are, 1, historically strong private sector balance sheets. Most companies and households, in aggregate, are just less burdened by crazy debt levels than in past cycles.
Okay.
2, he points to what he calls expansionary monetary policy, which is an interesting way to frame it when a lot of people feel the Fed's being tight, right?
Yeah, that's counterintuitive.
Maybe he means the total liquidity still in the system or specific programs still running. 3rd is labor hoarding by companies. Firms are really reluctant to lay people off even if demand dips temporarily. They remember how hard it was to rehire after the pandemic.
Makes sense.
And finally, he cites substantial deregulation as another factor stimulating economic activity.
So these 4 points, strong balance sheets, maybe looser policy than perceived, labor hoarding, deregulation, they combine to create what outcome?
Well, according to Dale, they collectively result in persistent above-trend household income growth. And crucially, income growth is what ultimately fuels consumption. And consumption, as we know, is the engine of the U.S. economy.
Okay, so given this seemingly strong data and these factors, he then asks a really interesting question. Why does a big chunk of Wall Street seem to constantly forecast doom and gloom and fight this resilient economy narrative?
Yeah, and firms want you to feel anxious and fearful about the future because fear drives demand. Demand for hedging products, for constant research updates, for active trading that generates fees and commissions.
Yeah.
He contends that a market that just kind of grinds higher with low volatility, supported by a resilient economy, is actually bad for certain business models on Wall Street that really thrive on fear and complexity.
So a smooth upward market is bad for the anxiety industrial complex.
That's essentially his argument, yeah. He links this directly to Myopic loss aversion. That's the behavioral tendency, where the pain of a short-term loss feels way worse than the pleasure of an equivalent gain.
Right. We all feel that.
Exactly. And this bias makes people really susceptible to the forecasts of what he calls perma-bears, those individuals or firms who are always predicting market downturns. Their negative forecasts, even if they're wrong over the long haul, resonate emotionally with investors and can successfully drive engagement and ultimately product sales.
Wow. That's a pretty cynical, but maybe realistic view of some market commentary out there.
It definitely offers a different lens, a different way to evaluate that constant stream of negative headlines you always encounter.
Moving to another key theme Dale discusses, sticky inflation. He expects inflation to stay elevated.
Yes, he sees ongoing price pressures. And he brings up an interesting point from a Wall Street Journal article also in your sources. It's about the trustworthiness of U.S. inflation data, suggesting potential issues like staffing shortages at agencies like the BLS and BEA could be impacting the quality of the numbers we actually get.
So the official government statistics might not be perfectly accurate. There might be flaws.
That's the concern raised in the article, yeah. But Dale offers a kind of mental model for dealing with this. He argues that even if the numbers are, made up or imperfect, they still contain signal, relative signal, compared to past numbers.
How does that work?
His analogy is like this. If some country reports GDP growth at 4.25% one quarter and then 5% the next, even if those exact figures aren't perfectly precise, the change from 4.25% to 5% still signals that growth feels better to the authorities reporting it.
Okay, focus on the trend, the direction.
Exactly. He suggests applying the same model to U.S. statistics. Focus on the direction and the relative changes rather than getting bogged down in minor potential inaccuracies.
Now, he also had some specific, and I should say pretty politically charged commentary on the inflation numbers themselves.
He did. He stated, and we should be clear, this is his stated opinion from the source material.
Right.
His belief that the Biden administration was, in his words, cooking the inflation books.
Mm-hmm.
He contends this was done by allowing a large influx of illegal immigrants. He cited over 10 million, which he argues helps suppress wage growth and therefore lowers the reported inflation figures. It's a very direct and certainly controversial take, linking policy and immigration directly to the official economic data.
And how does he suggest a listener, process that kind of commentary, especially given the political heat around it?
Well, his advice is pretty consistent with his broader philosophy. Basically, don't get triggered. Don't get triggered by the data quality debates or the political accusations. Accept the data as it's presented, imperfect as it might be. Focus on extracting the relative signal and the trend rather than getting lost in the political noise or worrying about potential massaging of the numbers.
That brings us nicely to his overarching philosophy about investing, which he describes using a rather simple phrase, squiggly lines.
That's right. He advises viewing investments as, and this is a quote, nothing or little more than squiggly lines on the screen that make the numbers in your account go up and down. It's a very deliberate framing, designed to strip away all the emotion and the narratives we tend to attach to assets.
And how does this simple view help investors navigate the market? Seems almost too simple.
Well, by reducing these complex investments to just abstract lines affecting your balance, it helps remove those emotional biases that so often lead to bad decisions. Buying high out of FOMO or euphoria, selling low out of panic.
Right.
He advocates for executing investment decisions dispassionately. Guided by systematic processes and signals, he mentions his own KISS and Dr. Mo indicators, which are designed specifically to override those cognitive biases that maybe Wall Street tries to exploit. It's all about disciplined execution based on a process, not reacting emotionally to every headline or data point.
It sounds like a way to stay grounded, really, in what can be a very noisy and emotional market environment.
It's about focusing on the mechanics and the signals, detached from all the emotional narratives swirling around.
Subscribe to the Snippet Labs YouTube channel. Okay, so taking those macro themes, the resilient economy, sticky inflation, the debates about data, let's see how they actually showed up in recent market action. Let's pull in insights from those other sources you provided, like the Yahoo Finance segments.
Absolutely. The latest jobs report you highlighted definitely seemed to fuel the market's recent moves. The data showed 139,000 jobs added in May, a pretty solid number, and the unemployment rate held steady at 4.2%.
And how did the market take that news? What was the reaction?
The market reacted strongly positive. Stocks jumped quite significantly on the last trading day of the week right after that report came out. All the major indices ended higher, pushing the S&P 500 back above the 6,000 mark. That reached its highest level since February.
So we're flirting with record highs again, getting close.
Just a short distance away, according to the reports you looked at. This really reinforces that idea that the underlying economic data is supporting market strength, at least for now.
Mm.
And we also saw other indicators reflecting this shift towards maybe greater risk appetite. The VIX, the volatility index, dropped down to a 16 handle. That's a significant move down, a 4-month low.
Wow.
Lowest it's been since February 21st, 2021. And notably, that was just 2 trading days after the market hit its previous all-time high back then.
That's a pretty strong signal, isn't it? That market participants are pricing in less expected turbulence ahead.
It really is. And the ISB Movie Index, which is kind of like the VIX, but for the bond market volatility,
Right.
that also headed lower, though maybe not quite as dramatically relative to its own history as the VIX drop was. But broadly, it suggests a reduction in expected volatility across different asset classes, reflecting increased confidence, maybe.
What was happening in the bond market while stocks were rallying? Were they moving together?
Interestingly, yeah, bond yields were actually climbing alongside stocks. The 10-year Treasury note pushed back above 4.5%, and the 30-year was approaching 5% again. Now, this combination of rising stocks and rising yields, sometimes that signals robust growth expectations.
Yeah.
But it also brings supply dynamics into really sharp focus.
And your sources highlighted significant bond supply coming up next week.
They did. Next week is heavy with Treasury auctions. You get 3-year, 10-year, and 30-year bonds hitting the market on Tuesday, Wednesday, and Thursday.
What's the risk associated with these auctions, especially with the yields already climbing?
The key risk that was highlighted is the need for strong demand, particularly from those large buyers, foreign central banks, big institutions. Those are the indirect bids you hear about in auction results.
Okay.
If interest from these major players seems weak at these higher yield levels, it could indicate trouble absorbing all this new supply. And that weak demand could force yields even higher, which could potentially spook risk markets like stocks, maybe causing them to tumble. So the outcome of these auctions next week, it's going to be a major test for the market.
Looking at sector performance during this rally, where did we see the leadership coming from?
Energy was the strongest sector, up around 1.9% on the day mentioned. It was followed by consumer discretionary, communication services, and financials. These 4 sectors were all actually outperforming the broader S&P 500. Tech was also solid, up about 1%. So it contributed to an overall picture where most sectors were in the green.
So not just a narrow tech rally then, but a bit broader.
That's right. While tech definitely remains dominant overall, the leadership on that particular day showed signs of broadening out a bit into some more cyclical sectors.
Now, despite this rally and the dropping volatility, your sources still pointed to some underlying anxiety among investors. Where's that coming from?
Yeah, the reports noted lingering concerns about, well, the future direction of trade policy. Still a lot of uncertainty there. Continued uncertainty surrounding the economy's long-term path, even with the recent strong data points. And anxieties related to the national debt and the deficit implications of potential future tax bills. Those big picture worries haven't gone away.
So what are the forces driving the current bullishness then? The ones that are currently overriding that anxiety?
Several factors were cited. The dominant narrative is still the strength of the AI trade and continued tech leadership. That's been a huge driver since the market low back on April 8th. There's also growing optimism, maybe hope, around the potential for positive developments on trade deals. Beyond that, there's the backdrop of just strong corporate fundamentals, clearly demonstrated by those robust Q1 earnings. S&P 500 earnings growth came in around 13%, which significantly beat the initial estimates of only 7%.
Right, that was a big beat.
Huge beat. And the idea floating around is that if some of the political headwinds, like maybe the harshest tariff threats, ease up a bit.
If the administration pulls back.
Yeah, if they pull back on some of the worst tariff rhetoric, as one source put it, then the strong underlying corporate performance and the resilient economy are kind of primed to outperform even further. The market seems to be pricing in at least some hope for a resolution on trade policy that avoids the most disruptive outcomes.
Follow us on Twitter @SnippetLabs for more updates.
Okay, let's transition now from those broader market and macro signals and really dive deeper into some specific areas. Areas impacting consumers and industries that are covered pretty extensively in your sources. Let's start with a check on consumer health, using that data from VantageScore.
Right. What's the key takeaway from that consumer credit data? What's the big picture?
The big picture insight, and maybe a bit unexpected for some, is that consumers seem to have shifted. They went from being cautious about borrowing to actually becoming net borrowers. They're significantly increasing their use of credit.
What's driving that? Why borrow more now if rates are high?
Well, a major force appears to be consumers proactively increasing credit utilization, and this is most pronounced in auto loans. The thinking is they're borrowing now at current prices to get ahead of anticipated price increases later in the year. Price increases potentially driven by those tariffs we keep talking about. It looks like a direct behavioral response to policy uncertainty.
So they're borrowing more, but are they still healthy overall? Is this sustainable?
According to the Vantage Score data for April, the picture is one of broad resilience. Average credit balances aren't showing, excessive increases across the board. Delinquencies, yes, they have increased year over year, but from very low levels.
Yeah.
And they seem to be moderating and still look resilient when you look at longer historical trends. And a particularly positive sign noted in the source, the percentage of the highest quality consumers, those with Vantage Score of super prime, that's 780 and above, actually increased in April. So that segment of the population, the most creditworthy, is expanding.
What would be the red flag then, the thing that undermines this resilience narrative?
I think the key risk would be if we started to see the employment picture weaken at the same time as consumers are increasing credit use.
Right, losing income but relying on debt.
Exactly. That would suggest people are losing jobs but trying to maintain spending by charging up their cards. That would be a bad sign. However, the source specifically states that employment was steady through April, and that provides a foundation, a reason for the current resilience we're seeing in the credit numbers.
You mentioned auto loans surging earlier. How significant was that surge?
It was quite significant, yeah. Auto loan borrowing really jumped in April. It reached levels actually higher than pre-pandemic levels, and the growth rate. It was the fastest seen since January 2020. And again, this is attributed directly to consumers trying to front-run those potential 50% to 100% tariffs on vehicles.
Wow. And how did student loans look now that those payments have resumed after the long pause?
Yeah, student loan reporting fully resumed in January and February after being paused for, over 2 years. Initially, the average Vantage score dropped by a full point in February as those payments started hitting people's reports.
Okay, that makes sense.
But importantly, the score has since rebounded to 702 and stayed there. And this rebound is seen as a healthy sign. It indicates that once people were confronted with the reality of payments again, they adjusted. They made those payments and they stabilized their credit standing. It suggests that in aggregate, there was enough room on household balance sheets to absorb that shock without a sustained breakdown.
And the Fed holding rates steady, how does that factor into this whole consumer credit picture?
Well, the Fed's decision to keep rates elevated means consumers continue to face relatively high interest payments, right? All else being equal, higher rates typically discourage borrowing. You'd expect fewer new mortgages, less impulsive maxing out of credit cards, generally lower credit utilization.
But that's not what we're seeing entirely.
Well, yes and no. Overall utilization isn't exploding, but the data shows consumers are increasing utilization in specific areas like autos, driven by these forward-looking tariff concerns. So the high cost of borrowing is definitely a real headwind. But these behavioral factors, this anticipation of policy changes, are currently pushing borrowing higher in very targeted ways.
Drop a like and share if you find this valuable.
And this consumer behavior, especially that surge in auto loans driven by anticipating tariffs, brings us squarely into the policy crossroads we really need to unpack from your sources, focusing on tariffs, trade, and the national debt.
And Rick Newman's perspective on the import data you pulled is particularly eye-opening here, isn't it?
It really is. The data point is quite startling. U.S. goods imports plummeted, a massive 20% drop from month to month in April. This wasn't some small dip. It was the biggest recorded drop since 1992, which is when this data series began.
20% in 1 month? What on earth is causing that?
The cause cited relates directly back to that trade policy uncertainty we've been discussing. Companies are essentially holding back. They're hesitant to import goods with the current tariffs in place and potentially higher ones looming.
So they're waiting.
You're waiting, yeah.
Okay.
Hoping for potential trade deals down the road that might lower tariffs, making it cheaper to bring goods in later. Now, some are paying the higher tariffs now, which is why, paradoxically, overall tariff revenue actually went up despite the huge drop in the volume of goods imported.
How tangible is the impact of this for the average person, for you listening?
Rick Newman's phrase puts it very simply. This is coming to a store near you. It means the actual amount of physical stuff being shipped into the United States is declining dramatically. And economists highlighted in your sources are actually likening this disruption to the chaos we saw in the early days of the COVID pandemic supply chains.
Wow. And if this trend continues, what could we expect?
If the situation persists on its current trajectory, the prediction from your sources is pretty stark. COVID-style shortages and price hikes within the next 1 to 3 months. A shrinking pipeline of imported goods will eventually mean less availability and potentially higher prices on store shelves.
This leads right into a debate we see reflected in your sources. Will these tariffs cause a sustained surge in inflation, or is it more complicated than that?
It is definitely more complicated, and the sources present different viewpoints. The nuanced debate is really whether tariffs lead to a sustained resurgence of inflation across the whole economy, or if it's just a temporary, one-time upward adjustment in prices for specific goods that maybe eventually reverses. Some argue that past tariffs mostly just cause price adjustments in the affected categories, not broad inflation, partly because companies might absorb some costs or consumers might just buy something else, substitute goods.
How does Jim Bianco view this? Does he think it's inflationary?
Jim Bianco believes that these tariffs will contribute to an uptick in inflation. He points specifically to real-time data from online price tracking services like Trueflation and Price Stats. These services monitor millions of prices on the internet constantly.
Okay.
And he notes that these services have shown prices for internet goods trending upwards over the last 3 to 4 weeks. He sees this as suggesting that some of the tariff impact is already being reflected in certain consumer prices, adding fuel to that sticky inflation theme we discussed earlier.
And what's the perspective from Goldman Sachs, specifically John Hatzius, their chief economist?
Goldman Sachs, through Hatzius, presents a different forecast. Their view is that core inflation will actually ease back to around 3.6% by the end of the year. They see the tariff effect mostly as a one-time price adjustment that will eventually roll off the year-over-year comparisons. They think its impact will dissipate into 2026. And based on this trajectory, Goldman predicts the next Fed rate cut might be as far out as 2026.
Wow, 2026. That's quite different from Bianco's same pressure now.
It really highlights the uncertainty, doesn't it? Bianco is looking at these real-time, high-frequency price signals that suggest immediate pressure. Goldman's forecast is based more on a model that anticipates things like substitution effects, potential cost absorption by companies, and the tariff impact eventually cycling out of the annual inflation numbers. It's a genuinely complex picture with valid arguments on both sides.
And this all ties into the bigger picture of the national debt situation and this concept that keeps coming up, a potential Liz Truss moment for the U.S.
Right. That concept arises from the real difficulty politicians face in addressing the major drivers of government spending. Things often called third rails, because they're so politically sensitive, you touch them and you get shock programs like Medicare, Medicaid, Social Security, disability benefits, and of course defense spending. These are huge structural parts of the budget.
And the Liz Truss example from the UK shows what can happen when the bond market basically revolts against unsustainable fiscal policy.
Exactly. When Liz Truss's government proposed those significant unfunded spending increases and tax cuts, the bond market reacted severely. It demanded sharply higher interest rates to finance all that extra borrowing. This caused UK government bond prices to collapse, led to a financial crisis, forced the government to completely reverse its plans, and ultimately Liz Truss lost her job as prime minister very quickly.
So the bond market effectively imposed the fiscal discipline that politicians wouldn't or couldn't.
That's the argument, yes. And the parallel drawn in your sources is that the U.S., with its own rising debt levels and this clear reluctance to tackle major spending categories, will eventually face a similar Liz Truss moment, a point where market forces just demand a change in the fiscal path. The big question is when. Is it relatively soon, maybe later this year, or is it further out, potentially 7 years from now, as one source speculated?
Have we seen any signs of this kind of market pressure starting to build in the U.S. bond market? Any tremors?
Well, the 20-year Treasury auction back on May 21st was cited as a potential early sign. It was described as very poor. Now, it wasn't a full-blown crisis, but it was seen as maybe a glimpse of potential waning demand for longer-dated U.S. government debt. Interestingly, auctions for shorter-term bonds, like the 2- and 5-year Treasuries this past week, have been okay.
Yeah.
That's likely helped by the current relatively flat yield curve, which makes the yields on shorter-term bonds look pretty attractive compared to the price volatility risk you take with longer-term bonds. But the broader context here is just the sheer volume of government borrowing happening globally. Sovereign bond markets need to raise something like $17 trillion this year. That's up from $14 trillion just 2 years ago. The U.S. accounts for about $2 to $2.5 trillion of that $17 trillion total. That is an enormous amount of capital that needs to be absorbed by the market. And as the old saying goes, there are no bad bonds, only bad prices. To attract that much capital, yields probably need to remain elevated globally until either the fiscal situations improve or demand somehow increases significantly.
This massive borrowing requirement definitely puts pressure on the Federal Reserve, doesn't it? Especially when you consider issues like that supplementary leverage ratio rule.
It certainly does. The latest Fed minutes, they were characterized by your sources as basically a whole lot of nothing, just emphasizing a cautious approach appropriate amid market uncertainty and being well-positioned to wait for clarity.
Yeah, pretty non-committal.
Very. And there's still that lingering Fed hate from certain corners, like Bill Dudley's really controversial suggestion that the Fed should actively use its power to sort of punish the current administration for its tariff policies. That view directly clashes with Chairman Powell's consistent stance that the Fed operates within the existing policy environment without commenting on whether it's good or bad policy.
Right.
Jim Bianco offers a really intriguing perspective on the relationship between the bond market and the Fed. He argues that when the Fed is seen as aggressively fighting inflation, the bond market actually relaxes and yields can be lower. But when the Fed appears hesitant or seems like it's giving up the fight, that's when the bond market gets nervous and demands higher yields. He contrasts the environment back in 2022 when inflation hit 9%, but the 10-year yield topped out around 4.22% with now. Inflation is lower now, but the 10-year yield is hovering above 4.5%. His somewhat contrarian view, maybe rooted in the dynamics of the 70s and 80s, is that if the Fed truly wanted to see bond yields come down sustainably, they should signal a greater willingness to actually hike rates further, to demonstrate their anti-inflationary resolve. He believes that would ultimately calm the bond market.
Wow, that completely flips the conventional thinking on its head, doesn't it? Hike rates to lower yields.
It highlights how the dynamics might have potentially changed or how complex they are. Look, the sheer magnitude of U.S. debt that needs to be rolled over and refinanced in the coming years, that must weigh on the Fed. Yeah. As James Carville famously said, the bond market can intimidate anyone. But the real structural answer to persistently high yields isn't necessarily more Fed intervention or manipulation. It's probably for Congress to reduce the amount it needs to borrow in the first place. Wow. And finally, there's discussion in your sources about the supplementary leverage ratio, SLR rule. This rule came in after the financial crisis. It requires banks to hold capital against assets like treasuries, which basically acts as a disincentive for them to buy government debt. Now, there's talk, mentioned by Scott Besson, of potentially getting rid of this rule maybe by this summer.
The idea being that removing it would make it easier or cheaper for banks to buy more government bonds, help absorb the supply.
That's the intended effect, yes, to increase demand from a major buyer base, the banks. However, the analysis you provided poses a really critical question. Banks, according to FDIC data from the end of Q1, are currently sitting on nearly $500 billion in unrealized losses on their existing bond holdings. Yeah. So given that, why would they suddenly rush out to buy more instruments they've already lost a ton of money on just because the regulatory capital requirement is lowered a bit? The view presented is that they probably won't. Not unless the fundamental picture improves significantly, meaning inflation comes way down, the deficit gets under control, or maybe a deep recession prompts a genuine flight to safety into government bonds. Just getting rid of the SLR without addressing those underlying issues of high deficits and sticky inflation is seen as unlikely to magically solve the bond demand problem.
Subscribe to the Snippet Labs YouTube channel.
Okay, let's shift gears a bit now. Away from policy and debt, let's talk about the impact of technology on the future of work. Drawing from insights in your sources, particularly the accelerating role of artificial intelligence, AI, we've seen some pretty striking numbers regarding job losses in the tech sector specifically.
Yeah, what were those figures again?
The sources cited nearly 60,000 tech jobs lost just this year alone. And that's coming right on the heels of around 150,000 tech jobs lost last year.
Wow. Is that AI directly displacing people? Is it robots taking jobs?
Well, it's a bit more nuanced than just a simple one-to-one replacement, although that is happening in some cases. The sources discuss how AI is influencing investment decisions within companies.
How so?
Firms might be less inclined to hire, say, younger or mid-level engineers for future roles if they believe AI tools are going to dramatically enhance the productivity of their existing senior engineers. If one senior engineer can do the work of 3 with AI, you might not need to hire those other 2 down the line. So it's influencing future hiring plans just as much as, or maybe more than, current roles being eliminated directly by AI today.
Are there specific examples of AI streamlining processes and impacting jobs right now?
Well, absolutely. Some very compelling examples were provided in your sources. IBM is reportedly using AI to handle functions typically done by their entire HR department, leading to significant reductions there. And Goldman Sachs is leveraging AI to prepare these lengthy, complex prospectuses, the documents for IPOs and things, in mere minutes. A task that previously required a team of maybe 6 lawyers working for 6 weeks.
Minutes versus 6 weeks. That's staggering.
It really shows the scale of potential efficiency gains and the potential job impact, even in highly skilled white-collar roles. However, it's important to remember, as one source citing economist Bob Gordon noted, that technological change throughout history has ultimately been a net creator of jobs.
Right, the creative destruction argument.
Exactly. It's often just really difficult to foresee the entirely new industries and the completely new job categories that emerge when ones are disrupted.
Like, who could have predicted the app economy before the iPhone?
Yeah.
Or the entire digital marketing industry before the internet really took off?
Precisely. Think about how something like the spreadsheet revolutionized finance, but also created demand for analysts who could use them. Or how Uber completely changed urban transportation, creating gig work but disrupting taxis. The specific jobs and industries that emerge from AI disruption might be totally unpredictable right now. The discussion also touched on the potential impact of self-driving cars and delivery technology, things being developed by companies like Waymo and Tesla. This technology could eventually lead to the loss of millions of driving jobs. Cab drivers, delivery drivers, long-haul truckers. That's a huge potential displacement.
But there's a potential upside, too.
Well, the counterpoint raised is that dramatically lower delivery costs could spawn entirely new industries. Industries built around ubiquitous, super low-cost logistics. You might see completely new business models emerge, centered around incredibly convenient delivery. Or maybe even self-driving car fleets adopted by whole communities or HOAs, potentially replacing the need for everyone to own their own car.
It's that classic disruption pattern again, isn't it? Painful dislocation now, but potentially transformative benefits later, often in ways we can't fully grasp today.
It really highlights the challenge of navigating this transition. The immediate job losses are highly visible and painful. The creation of new opportunities takes time, and it's much harder to predict exactly what they'll look like.
Follow us on Twitter at Snippet Labs for more updates.
Okay, let's delve into some specific industry deep dives now, pulling from your sources and connecting back to those broader market and macro themes we've been discussing. We can start with the pharmaceutical sector. It's seen both significant innovation and some policy pressure too.
Right. What's exciting in the pharma world right now, based on what you saw?
Well, in oncology cancer treatment, a significant new area of innovation is something called PD-1 bispecifics. This is a new class of drugs. They're designed to target two different biological pathways at the same time, specifically the PD-1 pathway, which is important for immune response, and the VEGF pathway, involved in blood vessel growth that tumors need.
Okay, hitting the cancer from two angles at once.
Kind of, yeah. And major players are investing heavily here. You've got collaborations involving Roche Genentech, Pfizer, Merck, they're all jumping in.
And the early data looks promising. Is it working?
The early data is described as very promising, yes. Now, if these results are confirmed in the larger, later-stage clinical trials, this could potentially disrupt the current standard of care in treating certain types of cancer. And that's highly significant because the current standard includes absolute blockbuster drugs like Merck's Keytruda. That drug is projected to bring in around $28 to $30 billion in sales. So yeah, there was a lot of buzz about these new bispecific drugs at the recent ASCO oncology meeting.
Wow. Beyond oncology, that GLP-1 market for obesity and diabetes just continues to be massive, right? And the focus seems to be shifting toward oral pills now instead of just injections.
Absolutely. Eli Lilly is widely seen as the frontrunner in developing an effective oral version. They're working on a pill called orforglipron. The really critical data readouts for this oral pill are expected later this year, specifically in the fall of 2025.
Okay, so still a ways off.
Still a ways off for the data, yes. If those results are positive, they anticipate filing for regulatory approval shortly after that, with a potential global launch starting in 2026, likely beginning in the U.S. first.
What's the expectation around pricing for the pill versus the injections? Will it be cheaper?
Well, the final pricing strategy hasn't been announced by Lilly yet, of course, but the baseline assumption analysts are using in their models is that the oral pill will likely be priced at some discount compared to the injectable versions, especially international markets.
Okay.
But this lower price point would likely be offset, maybe more than offset, by potentially much higher volume. Because, let's face it, a pill is just easier for most people to take than an injection, so it could expand the addressable market significantly.
Looking at how analysts view these companies then, what were the key stock ratings and the reasoning behind them for Eli Lilly and Pfizer in your sources?
Okay, so Eli Lilly has a strong buy rating,
Hmm?
and that's primarily driven by their perceived dominant position, their pole position, as the analysts put it, in this rapidly expanding GLP-1 market for obesity and diabetes. This market, currently estimated at around $30 billion, is projected to absolutely explode, potentially tripling to approximately $95 billion by the end of the decade.
Wow, triple in size.
Yeah, and Lilly is expected to capture and maintain just under 50% of this massive growth. Now, the analyst model does factor in significant price erosion over time, high single-digit erosion, due to increasing competition and price negotiations. But this is more than compensated for by the sheer volume growth expected from global launches, especially if the oral pill is successful.
Okay, so huge growth story for Lilly. What about Pfizer?
Pfizer, on the other hand, has a neutral rating currently. Their story right now is largely seen as one of operational efficiency and cost-cutting. Management is getting credit for executing that well. However, for the stock to achieve a higher valuation multiple, it really needs a clear revenue inflection.
Meaning they need to show growth again.
Exactly, a period of sustained top-line growth. While their early-stage cancer pipeline, including those PD-1 bispecifics we talked about, is promising, it's still early days. And Pfizer also has to navigate the next several years where key patents on existing blockbuster drugs expire. That creates significant revenue headwinds, the patent cliff. So, until there's concrete evidence that their pipeline can generate enough new revenue to significantly offset these patent expirations and drive overall growth, the stock is seen as kind of fairly valued where it is.
Got it. There's also a noticeable trend mentioned of pushing for more U.S.-based manufacturing in the pharma industry. What's driving that?
Yes, this has definitely gained traction, amplified by the supply chain vulnerabilities that were really exposed during the COVID-19 pandemic. There's been over $270 billion in investment announced recently for pharmaceutical manufacturing projects right here in the U.S.
$270 billion. That's a huge number.
It is. Many of these projects were already planned, but they seem to have been accelerated due to pressure and also potential tariff threats from the current administration. Companies are maybe hoping that committing to reshoring manufacturing might help mitigate some of those tariff risks.
But is that commitment certain? What if the tariffs actually go into effect anyway?
That's the big open question. Companies are kind of waiting to see the final details of any announced tariffs. If tariffs are implemented, the uncertainty is whether these pharma companies will actually continue with these ambitious reshoring projects as planned, or if they might slow them down or scale them back. Locations like North Carolina, South Carolina, and especially Indianapolis, which is particularly important for Eli Lilly's GLP-1 manufacturing needs, are seeing increased interest and investment right now. The larger strategic question is whether this whole investment push will succeed in significantly bringing manufacturing back to the U.S. and whether it will ultimately satisfy the administration's policy goals on trade and supply chains.
Let's look at some tech giants now, specifically Apple and Tesla. They've both seen some significant and sometimes pretty unusual developments lately, according to your sources.
Yeah, starting with Apple. The stock has had a really tough start to the year, down about 20% year-to-date at the time of the report. The Wall Street Journal actually noted that this is the worst performance for Apple shares heading into its big annual Worldwide Developer Conference, WWDC, since way back in 2010.
Wow, worse since 2010. What's behind Apple's struggles right now?
Two primary factors were cited. First, perceived stumbles on AI. And second, ongoing issues in China. On AI, Apple reportedly signaled its big intentions to bring AI to the masses about a year ago, but then apparently missed some internal deadlines and even pulled some related advertising. That led to investor disappointment.
Okay.
In China, Apple is facing real challenges losing market share to domestic competitors like Huawei, and that's compounded by a sense of nationalism there, encouraging consumers to buy Chinese phones. So the pressure is really on for Apple to unveil something compelling, something exciting at WWDC next week to try and change this negative narrative and boost investor confidence again.
Right, WWDC is key for them. And Tesla, they had a particularly volatile week, influenced by factors far beyond just typical market news.
Oh yeah, it was described as a truly wild week for Tesla, marked prominently by a very public, very sharp feud between Elon Musk and President Trump. The stock reacted immediately and sharply, dropping more than 14% on Thursday alone, which equated to wiping out over $150 billion in market capitalization.
$150 billion in a day. Ouch.
Huge drop. although it did recover some ground on Friday.
Yeah.
The catalyst for the big drop seems to have been Musk's harsh criticism of Trump's proposed spending plan, which Musk called a disgusting abomination.
This is quite a turnaround, isn't it? Because they were seen as aligning at least somewhat previously.
They certainly were. Your sources actually recap their history, including Musk's past endorsement of Trump, his appearances at rallies, a pledge of support to a pro-Trump super PAC, and even a brief role advising the Trump administration early on. So yeah, this feud represents a really significant shift in that relationship.
And analysts seem divided on the long-term impact of this public clash. Does it hurt Tesla?
They are definitely divided. Some analysts see it as a significant blow, both to Tesla's stock price and maybe to Musk's reputation. They think it could take a long time for the stock to fully recover. Others, though, like Morgan Stanley's Adam Jonas, who maintains an outperform rating and a very high price target, $1,410, view the sell-off as potentially a buying opportunity.
Why so bullish still?
Well, his bullishness for Tesla extends way beyond just the electric vehicle market. He focuses heavily on the company's potential in AI, in autonomy, and even in space technologies via SpaceX. However, the risk remains, and this was highlighted, that the upcoming tax bill could potentially eliminate or reduce the EV tax credits that have historically benefited Tesla. That adds another layer of policy risk to the stock, separate from the Musk-Trump drama.
Right.
An interesting side note raised was a comparison chart in your sources. It contrasted the performance of an equal-weighted index of certain tech, Bitcoin, and PE proxy stocks, kind of seen as representing assets popular with the bro-billionaire crowd, versus the Russell 2000 Small Cap Index, which is sometimes seen as a proxy for the Trump base or maybe Main Street. The chart showed the bro-billionaire index was elevated but kind of off its highs, while the Russell 2000 was actually leading recently up over 3% this past week, suggesting maybe different segments of the market are reacting differently to the current political and economic climate.
Interesting dynamic. Tesla also has a major scheduled event coming up soon that's highly anticipated, right?
Yes, they are planning the launch event for their robo-taxi service in Austin next week. This is a really significant planned milestone for the company's long-term autonomy ambitions. It will be very closely watched by investors in the industry.
Shifting now to retail and apparel, we saw some very different results from major companies in that space lately.
We did indeed. A real contrast. Lululemon shares were sinking pretty hard after the company lowered its full-year profit guidance. And they were quite explicit about the reasons, citing higher tariff-related costs and the need for increased markdowns as key factors hitting their profitability.
So a direct acknowledged impact from tariffs on their bottom line.
According to their own guidance, it appears to be exactly the case, yeah. This really highlights how specific companies are directly exposed to trade policy shifts. But then, in stark contrast, Rent the Runway shares were soaring.
Really? What's driving that positive performance for Rent the Runway? They're in apparel, too.
Rent the Runway reported hitting an all-time high in active subscribers. They showed record sequential growth. Their strategic corporate transformation efforts seem to be really paying off, including significant investment in doubling their new inventory and innovating their product offerings, which seems to be leading to high customer loyalty. And they saw growth even in their higher-priced subscription tiers, despite the uncertain macro environment.
So people are still willing to pay for rentals.
Apparently so. And Rent the Runway is being framed in your sources as a particularly compelling value play in the current climate. Think about it. For a monthly fee of maybe $100 to $150, subscribers get access to literally thousands of dollars worth of clothing. Now, as potential tariffs threaten to increase clothing prices elsewhere,
Right.
the relative value proposition of renting becomes even stronger. This creates potentially significant tailwinds for the rental and resale markets overall. Their revenue share model with fashion brands is also seen as a positive. It positions them as a valuable marketing and customer acquisition channel for brands, often with lower customer acquisition costs than traditional retail.
Interesting. How are physical retail locations like malls faring in this environment? Are people still going?
Well, data cited from Placer.ai indicated that foot traffic actually increased across all major mall formats recently. Indoor malls were up 6.7%. Open-air malls up 5%, and outlet malls, like Tanger, were up 3.9%.
Why is that, do you think?
There's a sense that, amidst all the economic uncertainty, shopping is being seen partly as entertainment, or maybe retail therapy, driving people to physical destinations for the experience. Retailers who have agile supply chains seem to be navigating the tariff environment more effectively than those locked into less flexible sourcing arrangements.
Okay.
And retailers are even proactively encouraging early back-to-school shopping. trying to get people to buy now to ensure item availability later in the year, anticipating potential tariff impacts on inventories. There's also the potential flip side. Maybe excess inventory in deals in the back half of the year if the tariff situation resolves more favorably than currently feared. Kind of like what happened after the post-COVID supply chain disruptions finally eased. The contrasting experience is Lululemon struggling with tariffs versus Rent the Runway thriving, or even different apparel companies like Guess managing tariff exposure differently from G3, which actually withdrew its forecast. It really highlights that the impact varies greatly. It depends on a company's specific sourcing strategy, who their customer base is, and how much pricing power they have.
And speaking of trade tensions and supply chains, the situation with U.S.-China trade, particularly focusing on those critical rare earth minerals, is a really key point of negotiation and friction right now.
It absolutely is. The recent agreement for an in-person meeting between President Trump and President Xi is seen as a positive signal, hopefully opening the door for some progress. But the situation with rare earth minerals remains a central and extremely challenging issue.
What actions has China taken recently regarding rare earths? Remind us.
Back in April, China imposed export restrictions on rare earth minerals. They started requiring companies to obtain specific licenses for any exports. They also placed 16 U.S. companies, 15 of which are in the critical aerospace and defense sectors, on a restricted list, making it basically impossible for them to access these materials from China.
Okay. And then there were negotiations.
Yes. Following negotiations in Switzerland, China did agree to remove those specific 16 U.S. firms from the restricted list. So technically, those companies can now apply for export permits again.
But getting the permits is still a problem. It's not flowing freely.
That's the critical bottleneck right now. The sources indicate that China is simply not issuing these permits quickly enough. The understanding is that only about 25% of requested permits have actually been approved. This is a huge shock to U.S. industries that were used to a system where there was effectively no export licensing requirement from China for these materials before. It is directly causing supply chain disruptions right now.
How far-reaching is the impact of these minerals? Why are they so important?
The impact is incredibly widespread and absolutely fundamental. Rare earth minerals are described as imperative for almost every modern industry. We're talking critical components for defense technology, warships, fighter jets, missiles, lasers, tanks. They are essential in automotive manufacturing, everything from seatbelts and stereos to steering wheels, and crucially, electric vehicles rely on them. They're also vital for medical equipment like MRI scanners and certain advanced cancer treatments. Disruptions in the supply chain for these minerals, they are felt very quickly. Sources suggest companies could start running out of certain materials within just 60 to 90 days.
And the U.S. is particularly vulnerable here. We don't produce our own.
Extremely vulnerable. While the U.S. does mine some heavy rare earths domestically, it currently has zero capability to separate them into the individual usable elements needed for manufacturing. Until early this year, all the material mined in the U.S. was actually sent to China for processing. Now, the U.S. is apparently stockpiling this raw material while trying desperately to build domestic separation capacity, but that's a complex multi-year process.
So China holds all the cards right now.
Pretty much. This gives China immense leverage. They have a near-complete global monopoly on the processing, supplying around 95% of the world's processed rare earths. By strategically retaining this export licensing framework, even if they remove specific companies from a restricted list, they maintain the ability to control access and exert pressure whenever they choose. Looking ahead to that potential July 9th deadline for new U.S. tariff actions, China is clearly pushing for a more permanent solution than just temporary permit approvals. Specifically, they're demanding zero tariffs from the U.S. If the U.S. isn't willing to meet that demand, the restrictions on rare earth exports are likely to continue or potentially even expand to other critical minerals.
Drop a like and share if you find this valuable.
Okay, so navigating all these intersecting signals, the market moves, the macro trends, the policy uncertainties, the industry specifics, it really requires thoughtful investing strategies. Your sources offered insights from a few different perspectives on how to position portfolios amidst all these crosscurrents.
Right. What was Thomas Martin's approach, for instance?
His approach really emphasizes maintaining diversification across various asset classes, across geographies, U.S. versus international, and within equities, across different styles, growth, value, large cap, small cap. He notes a current tilt with an overweight position in mid-cap and mid-cap growth stocks, and an underweight in international markets right now. A key feature of his current positioning is holding dry powder cash. having capital ready and available to deploy when specific opportunities arise. He also mentioned having a significant exposure to gold and gold miners, viewing them as a valuable substitute asset class in this uncertain environment. And he noted this positioning has performed well for him lately.
How do earnings expectations factor into his thinking right now? Q1 was strong, but what about going forward?
That's a key point. Despite those strong Q1 earnings results, where S&P 500 growth significantly beat estimates, the earnings estimates for the rest of the year, Q2, Q3, Q4, have actually been lowered since then. So the expected growth trajectory for the full year has softened somewhat. His focus, therefore, is on identifying individual companies that seem to have the ability to navigate this environment of uncertainty well, rather than simply betting on broad market growth continuing at the same pace.
Where does he see specific opportunities amidst this uncertainty? Which sectors?
He specifically highlighted potential opportunities in healthcare, communication services, particularly companies involved in entertainment and experiences, and industrials. Speaking of market catalysts and where opportunities might lie, Ross Mayfield also pinpointed some key factors he's watching closely.
What catalyst is he focused on? What needs to happen?
Mayfield believes the market needs to see tangible progress on trade deals, not just optimistic talk. That July 9th deadline for potential new tariff actions is approaching fast, and so far, the U.S. has only completed one relatively minor half deal with the U.K. out of the 60 or 70 countries potentially affected by the tariff regime. Another major catalyst he mentioned is the potential big tax bill. There's a hoped-for deadline around July 4th for that. This bill is significant both for its implications for bond yields, because of the potential debt and deficit impact, and as a potential source of fiscal stimulus, possibly including incentives for business investment.
Okay, trade deals and the tax bill. What else?
He also mentioned the Fed as a potential catalyst, suggesting, somewhat surprisingly to many, that they could potentially cut rates as early as June. That's ahead of the market's general consensus expectation of September. However, he acknowledges that the bar for a rate cut is pretty high right now. It would likely require data showing a significant economic weakening, maybe even pointing towards a recession, which isn't really the current picture. He also notes that the uncertainty created by potential tariffs makes the Fed more cautious about making any sudden moves.
You mentioned industrials as an appealing sector earlier. Both Martin and potentially Mayfield seem interested. Why is that group standing out amidst all this uncertainty?
Well, beyond just their recent technical strength and market momentum, industrials offer some compelling secular structural stories that are appealing when everything else feels volatile. These include that significant global push for increased aerospace and defense spending, partly encouraged by the U.S. administration pushing allies to spend more. There are the trends of reshoring and nearshoring manufacturing to reduce supply chain risk. And then there's the massive infrastructure build-out required for AI data centers and broader electrification. These are seen as powerful, long-term drivers that are relatively independent of short-term tariff policies or even which specific administration is in power. That gives them a certain resilience in this environment.
Makes sense. Finally, Jim Bianco offered insights on how to invest specifically in an environment where inflation remains persistent, say it sticks around 3% for a while. Yeah, what does an investment strategy look like for that kind of sticky inflation scenario?
Well, in a world with persistent 3% inflation, he suggests considering a few things. T-bills. Short-term Treasury bills are currently yielding in the low fours. They could potentially offer a positive real return, meaning a return above the rate of inflation. Assets like TPS, Treasury inflation-protected securities, gold, and commodities are expected to be better investment choices than many traditional assets, as they tend to perform relatively well when inflation remains elevated. Equities, stock markets, in his view, face significant valuation problems in this kind of environment, because higher persistent inflation means future corporate earnings are discounted back to the present at a higher rate, which makes current stock prices look less attractive relative to their future prospects.
Subscribe to the Snippet Labs YouTube channel.
Okay, moving beyond the pure market numbers and economic trends for a moment, your sources also include some really practical insights. Insights on how significant life changes impact personal finances and, importantly, tax situations. This gives the perspective of H&R Block.
Right. Why is it so important to pay attention to these life changes from a financial perspective? Seems obvious, but maybe people miss things.
Because major life events fundamentally alter your financial picture. And, crucially, they alter your tax situation. Most people manage their taxes throughout the year,
Right.
either through tax withholding if they're employees that's done via their W-4 form,
Right.
or through making estimated payments if they're self-employed. The problem highlighted is that many people simply fail to adjust their withholding or their estimated payments when a significant life change occurs.
Like what kind of changes?
Well, for instance, if you take on a second job, your employer for that second job, they only consider the income from that job when calculating how much tax to withhold. But our tax system is progressive, right? Your total income determines your overall tax rate. So the income from your second job will actually be taxed at your highest marginal rate. And if withholding isn't adjusted properly on either your main job or your second job's W-4, you're likely under withholding taxes, which means you could face owing a chunk of money or getting a much smaller refund than you expected come tax time.
Ouch. What about changing primary jobs? That happens all the time.
Yeah, when you change jobs, you really need to look closely at the W-4 form for your new coefficient. Consider how any pay raise impacts your overall income bracket. And if you're married, it's absolutely critical to review your spouse's withholdings at the same time. A really common mistake highlighted in the source is when both spouses independently claim the full child tax credit on their respective W-4s.
Double dipping accidentally.
Exactly. Each employer withholds taxes based on the assumption that the full credit is applied just to their income stream. But when you combine everything for your joint tax return, you've effectively doubled up on claiming the credit for withholding purposes, again, leading to under-withholding and a potential tax surprise. On the purely financial side of getting a pay raise, the advice is clear. Be disciplined. Try hard to avoid that lifestyle creep where your spending just rises to meet your new income. It's actually a great opportunity to reset your budget, maybe significantly increase contributions to retirement accounts, and ideally set up an automatic transfer to scoop some of that extra income directly into a savings account before you even see it.
Good advice. Getting married must be one of the biggest changes from a tax perspective, right?
Oh, it's huge. Marriage significantly changes your filing status, and that impacts everything from tax brackets to eligibility for various deductions and credits. It's highlighted as an absolutely ideal time for a mid-year tax checkup, like the kind H&R Block offers, just to make sure your combined withholdings are correct for your new joint income situation. And beyond just the taxes, the source stressed how crucial it is for couples to have open conversations about finances, including things like whether to have joint accounts, how to manage bills early on, to prevent friction and misunderstandings down the road.
Definitely. And for those approaching or maybe already in retirement, what are the key financial considerations?
Retirement involves a complete resetting of your income flow, obviously. Key decisions include when to start taking Social Security benefits. Taking them early, say at 62, means a lower monthly payment, but you start receiving it sooner. Deferring them up to age 70 can lock in significantly higher monthly payments for the rest of your life. This decision often depends heavily on individual financial need, health status, and expected longevity. Also, with retirement plans like 401ks or IRAs, distributions aren't always mandatory immediately upon retiring. Delaying distributions allows those funds to continue growing tax-deferred or tax-free in the case of Roth accounts. Required minimum distributions, RMDs, don't actually begin until a specific age, currently 73 for most people. Until then, there's flexibility. Working with a financial professional to strategically time when you take distributions is highly recommended to optimize your tax situation and make your savings last throughout retirement.
Follow us on Twitter at Snippet Labs for more updates.
Okay, finally, let's wrap up with some really fascinating research from your sources. Research about who is actually driving a significant part of America's economic future, specifically the founders of these highly innovative, high-growth companies. This study focuses on unicorn founders and the crucial role of immigration, led by Professor Ilya Strublev.
Right. What does his research reveal about the founders of these incredibly successful unicorn startups? The billion-dollar companies.
His findings are quite compelling, actually. The research shows that of all the founders of these unicorn startups, these relatively young, venture capital-backed companies valued at over $1 billion, more than 4 out of every 10 are foreign-born. That means they are first-generation immigrants. And if you expand that definition to include second-generation immigrants, those born in the U.S., but with at least one immigrant parent, that number jumps incredibly high. 7 out of 10 unicorn founders fit that description.
7 out of 10. Wow, that's a massive proportion. Which countries are the leading sources of these immigrant founders?
The study identifies India as number 1 and Israel as number 2. The reasons cited include India's large population and its relatively strong technical education system, particularly the famous IITs, and Israel's well-known status as a high-tech innovation nation, the startup nation.
Is there a strong connection between these founders and the U.S. education system specifically? Did they come here for school?
A very strong connection, yes. The vast majority of these immigrant founders graduated from top U.S. universities. The study specifically mentioned the top 30 ranked schools. Many were also affiliated with these top institutions in other capacities, maybe as faculty members or researchers before starting their companies. And a unique feature highlighted about these top U.S. universities, something that might contribute to this phenomenon, is their interdisciplinary nature and the way they integrate cutting-edge research directly with teaching. This combination fosters an environment where new ideas can cross-pollinate between fields and be rapidly tested, creating a really fertile ground for innovation and entrepreneurship, perhaps in a way that's harder to achieve in more traditionally siloed academic systems elsewhere.
Now, the source notes that there's a potential risk looming related to this pipeline of innovation connected to policy.
Yes, the concern stems from policies like that Trump administration proclamation, which temporarily suspended entry for certain foreign nationals coming to the U.S. for study or exchange programs. Harvard was specifically mentioned in the context of the court challenges to that rule. Although that specific proclamation was ultimately blocked by the courts, the risk that similar restrictions could be implemented in the future still lingers.
And why is that a risk specifically for innovation?
Well, given this data clearly showing that immigrant founders, often educated right here at these top U.S. institutions, are disproportionately critical to creating these high-growth unicorn startups, policies that restrict their ability to come here, to study here, or to stay here after graduation pose a potentially significant threat. A threat to the future of American innovation and new business creation. It cuts off a vital source of dynamism for the economy.
Drop a like and share if you find this valuable.
So when you look across this entire stack of sources you provided, you really see a landscape just full of conflicting signals, don't you? You've got the granular market mechanics revealed by those Bitcoin liquidation heat maps showing concentrated risk and liquidity points right now. Then you have the macro perspectives, highlighting economic resilience, but also persistent sticky inflation, and even potential data quality issues clouding the picture. The market reaction itself is broadly positive lately, hitting multi-month highs, yet there's this undercurrent of anxiety about trade policy and debt that just won't go away.
Right.
You see consumer resilience in the credit data, but also these strange behavioral shifts driven by policy anticipation, like buying cars now to get ahead of potential tariffs. Policy itself is just a massive cross-current. You've got import plunges pointing to potential shortages, this whole debate about whether tariffs will cause inflation or just adjustments, the looming specter of a Liz Truss moment for U.S. debt. And the Fed is trying to navigate all this complexity with rules like the SLR potentially changing the game for banks.
Yeah, it's a lot.
It is. And then you throw in AI, promising future growth but causing job displacement now. Specific industries show both incredibly exciting innovation, like in pharma with GLP-1s and PD-1s, but also extreme vulnerability to policy, like Lululemon with tariffs or the whole U.S. industrial base with the rare earths choke point. Investing strategies have to somehow account for all these cross-currents, thinking about diversification, cash levels, inflation hedges. Even personal finance decisions are impacted by these broader trends and require proactive management through life changes. And maybe underlying it all, you find out the engine of future innovation is heavily fueled by immigrants whose future access to the U.S. could be at risk depending on policy choices.
It's dizzying when you lay it all out like that.
It really is. So for you, the listener, digesting all this, the resilience versus the risks, the innovation versus the disruption, the policy impacts versus the market optimism, how do you reconcile these seemingly contradictory forces when thinking about your own financial path, your own investments, and the economy unfolding around you? It really seems like the true deep dive isn't just absorbing all the data points, it's grappling with the why behind them and how they all interact, even when the numbers themselves might be debated or influenced by factors way beyond simple economics.
Markets move fast, pinpoint your next profit window, and seize the moment.